isn't it?
There's really no one to point the finger at. Collectively, we're all in it together, and we're really all to blame for it.
Hmm. Hmm. Well, that's fair. I think that's very fair, and I personally don't like to see the finger point at any one thing, though you hear it on the campaign trails. But that's just it. We're all responsible for our own actions, and even if we're blindsided by what the rest of the society's doing, it's really, if they jump over the bridge, are you going to too? And I'm sure there were some people who said, look, I might be able to the bank might give me the money, but I'm not going to take it. Right?
Right.
But that'd be a hard thing not to take.
Because I know I'll be overextended, and
right.
if anything happens in the next year or two, where my income fluctuates at all, interest rates change, any of these variables that can happen, if anything's changed, I may not be able to afford my mortgage.
It's really the denial of a social trend that the wise person has to do in that case. Because all your siblings, all your friends, all your family, everyone down the street, they're all moving, they're buying a bigger home, and you're not. I mean, I think we could have a sociologist on this show too and talk about the factors, right? I mean, you can talk about the numbers, but really, the reasons why, I think, are very sociological, psychological. I think that makes a lot of sense too, and I think that's interesting. But there was a big trend overall in the United States to buy a home too, right?
I believe that stems back from, when all the GIs came back from World War II,
mm-hmm.
and they, and then the baby boom generation came from that, and it was just part of the American dream to, own your own home, have your own, spot of land, and that's generally, the consensus what the average American wanted.
And of course, at the time when these loans were going cheap, they could afford them for those 3 years.
Sure.
Well, what happened after 3 years that the money wasn't so cheap anymore? Interest rates went up, right? Why did they go up?
Why did interest rates go up? Well, if we're talking about like someone's individual loan, if it was an adjustable rate mortgage.
Yeah.
The contract itself, the loan itself, had that written in the language, and without getting into all of that, say it was adjustable after 3 years.
Uh-huh.
Well, it's going to adjust up. That's just how the language is written.
So they knew it would go up. But it doesn't necessarily have to go up, does it?
Technically, it doesn't. And people who got into those types of loans, I would say most of those people were assuming that they would be getting out of them before they adjusted.
Yeah,
and
I can see that. And
by the time that
happening
happened,
too.
it was, now it's hard to get a loan, and people are starting to foreclose.
Well, what do you, what do you have to say, to the people in these uncertain times now? Getting out of the housing stuff and getting more into, what a family or an individual can do to, begin to, save for retirement.
Mm-hmm.
Aside from the obvious, everyone needs to save more because that's obvious. But you need to save. But not just that. What should one do? Let's say first for the new investor, the person who's just starting to make a little bit more than they're spending, and they're finally figuring out that they should probably start to develop that habit,
right.
Month in and month out for the rest of their lives. What should they do with that excess cash?
Before you would get into any type of investment, you really want to know, what am I saving this money for?
Uh-huh.
Am I saving it for a down payment on a house in 2 years? Am I saving it to send my kid to college in 5 years? Am I saving it for retirement in 15 years?
Mm-hmm.
Those really matter when you decide what to invest in. And then from there, it's important to talk to a professional to really figure out what types of investments personally you would want to get into. Generally, people starting out will buy into a single mutual fund, a diversified mutual fund. Start building their capital base and then diversify from there. I mean, as far as market conditions, it really doesn't matter what the market's doing right now, because if you need that money in 2 years, you shouldn't be investing in stocks anyway. Stocks are inherently too risky for that short of a time frame. You should be holding your money in cash. If it's for retirement in 15 years, all research and conventional wisdom talks about saving systematically on a regular basis and being well diversified, and that's talking about diversified in your stock portfolio, diversified in your bond portfolio, holding cash, etc. And the timing of the market is really insignificant.
Huh. Well, that's interesting. Timing of the market is insignificant when I don't think that sinks into most people's heads. Well, would you agree?
Well, that's when we get into the psychology of the psychology of investing is completely different.
A professional financial planner is saying, it's not nearly as big of a factor as you might think it is.
Right.
And then what would you? And then to the person out there who has, maybe a few dozen. No one speaks like that. Who might have $10, $20, $30, $40, $50,000 in savings, $100,000, whatever. They're probably going, "What the hell do I do?"
Well, saying that market timing is insignificant, I say that assuming that they have their accounts, their portfolio structured how they should be in the first place. And that has to do, like I said, how long until you need to spend the money. You shouldn't be taking that much risk if you need to spend it soon.
Yes.
But you also, it's also hard psychologically not to get too aggressive when the market's doing well. There's money to be made. The returns are good. Let's juice it up a little bit, be a little more aggressive, and get a little bit more return out of it. So when the market does correct, you're going to get bit.
Yeah, and the people who really know what they're doing are the ones who make a profit from those who over-aggressively buy when the market's going up, right?
There's always someone making money out there, correct?
Yeah. I put your website up, Ryan@webfinancial.com. Email him with any questions. He works at Web Financial and handles retirement accounts for individuals or families, businesses, individuals, mainly?
Mainly individuals. There's a couple institutional clients, but yes.
Okay. But he welcomes any questions you might have. As well, and because we're out of time, we have to wrap things up. But if you have any suggestions or questions for me regarding my guests or the show, for me, whatever, feel free to email me. You should see this episode as well on my weblog. But first, my email, mplsexpression@yahoo.com, and then my weblog at mplsexpression.typepad.com. Thank you very much for joining. Thank you very much for joining us today on Minneapolis Expression. I hope you got a lot out of this conversation. And looking forward to it next time when I bring on Minneapolis's most interesting and expressive individuals here on Minneapolis Expression. Thanks.